Welcome back to our series on navigating the path to homeownership. I'm Duane Buziak, a senior mortgage loan officer. Today, we're diving into the different types of mortgage loans available. Understanding these options is key to finding the right financial vehicle for your home ownership goals. My aim is to explain these major loan types clearly, highlight their benefits and requirements, and help you understand which might be the best fit for your circumstances. As a seasoned mortgage professional, I've had the privilege of guiding many individuals and families. My role is to make this process transparent and understandable, ensuring you're well informed to make the best decisions for your financial future. The foundation. What are we talking about? When we talk about different types of mortgage loans, we mean various programs offered by lenders to help you finance a home. They differ by who backs them, eligibility, down payment expectations, interest rates, and even property types. Knowing these distinctions can save you significant time and money. Think of it like choosing a vehicle. You select based on your specific needs, not just any car. Mortgage loans are similar. They are tailored to different needs and circumstances. My experience comes into play here, having helped numerous clients navigate this complex landscape. I've seen firsthand how choosing the right loan profoundly impacts a buyer's financial future. It's about securing the loan that best serves your long-term goals. Let's start with conventional loans. These are home loans not insured or guaranteed by a government agency, like FHA, VA, or USDA. They're backed by private lenders and conform to guidelines set by Fannie Mae and Freddie Mac. Key features of conventional loans. Credit score generally requires good to excellent credit. Typically, a FICO score of 620 or higher scores usually mean better interest rates. Strong credit demonstrates reliability and often secures more favorable loan terms. Down payment. Flexible options from as low as 3%, 5%, or 10%. However, putting down less than 20% usually requires private. Mortgage insurance, PMI. This flexibility makes home ownership more accessible, even without a large down payment. Private mortgage insurance, PMI. If your down payment is under 20%, PMI is required to protect the lender. A significant advantage is that PMI can often be canceled once you reach 20% equity in your home through payments or increased home value. This reduces your monthly costs in the long run, unlike some other loan types where mortgage insurance may last longer. Loan limits. Conforming limits. These loans have specific limits, updated annually by Fannie Mae and Freddie Mac, usually in the mid-$700,000 range for most areas. If you need to borrow more, you'd typically look at a jumbo loan. Property types. Versatile. Usable for single-family homes, condos, townhouses, and even multi-unit properties, up to 4 units if owner-occupied. Loan terms, most commonly 15-year or 30-year fixed-rate mortgages, offering payment stability. Adjustable-rate mortgages, ARMs, are also available, where rates can change after an initial fixed period. Benefits of conventional loans. Flexibility, wide range of terms, property types, and down payment options. Unlike FHA, no upfront mortgage insurance fee. PMI, cancellation, ability to remove PMI, reducing long-term costs. Fewer property restrictions, generally less stringent property condition requirements than FHA or VA, who are conventional. Loans best for borrowers with strong credit, stable employment, and at least some down payment savings. They are also ideal for those wanting the flexibility of potentially dropping PMI later or purchasing higher value homes within conforming limits. If you have solid financial footing, conventional loans often provide the most flexible and cost-effective long-term solution. My experience includes helping clients optimize conventional loans. For example, I've guided clients with excellent credit who, instead of a large down payment, opted for a smaller one to keep cash reserves, understanding how PMI would work and how to remove it later. This kind of flexibility in managing upfront costs is a key advantage. FHA Loans. Expanding access to homeownership, FHA loans are insured by the Federal Housing Administration. They aim to make homeownership more accessible, especially for first-time homebuyers and those with less than perfect credit or limited down payment funds. The FHA doesn't lend money directly. It insures loans made by FHA-approved private lenders, reducing lender risk. Key features of FHA loans. Credit score. More forgiving, potentially qualifying with a FICO score as low as 580 for 3.5% down. Some lenders might go down to $500 with a 10% down payment. This flexibility opens doors for many. Low down payment requires a minimum down payment of just 3.5% of the purchase price, significantly lowering the entry barrier. This 3.5% can even be a gift from a family member. Mortgage insurance premium, MIP. FHA loans require both an upfront MIP, UFMIP, currently 1.75% of the loan amount, usually financed, and an annual MIP, paid monthly. For most FHA loans with less than 10% down, the annual MIP remains for the entire life of the loan. With 10% or more down, it can be removed after 11 years. This impacts long-term monthly costs. Property standards. Homes must meet specific FHA. Property standards for safety and soundness, ensuring a safe living environment. An FHA appraisal checks for issues like peeling paint or structural problems. Loan limits. County-specific loan limits apply, generally lower than conventional limits designed for modest to moderately priced homes. Assumability. FHA loans are assumable, meaning a future qualified buyer might take over your loan, potentially benefiting from your existing interest rate. Benefits of FHA loans: lower credit score requirements, more inclusive for a wider range of borrowers. Low down payment, only 3.5% down, making home ownership more attainable. No prepayment. Penalty: flexibility to pay off your loan early. Gift funds. Allowed, down payment can come entirely from a gift. Who are FHA loans best for? First-time homebuyers, individuals with lower credit scores, or those with limited down payment funds. FHA loans provide a crucial stepping stone into the housing market. I've seen FHA loans unlock home ownership for countless clients. For example, a young couple with strong employment but limited savings and some past student loan challenges found an FHA loan with its flexible criteria allowed them to buy their first home. We guided them through the process, and their excitement at closing was a testament to the program's impact. VA loans are an incredible benefit for eligible veterans, active duty military personnel, and certain surviving spouses. Guaranteed by the U.S. Department of Veterans Affairs, they help those who served achieve home ownership with significant advantages. The VA doesn't lend directly, but guarantees loans from private lenders, allowing for more favorable terms. Key features of VA loans: no down payment, often. A key feature is 100% financing, meaning no money down for most eligible borrowers. This can save tens of thousands of dollars up front. No private mortgage insurance, PMI. A major advantage: VA loans do not require PMI, regardless of down payment. This means significant monthly savings compared to conventional or FHA loans. Competitive. Interest rates. VA loans typically offer some of the most competitive interest rates, often lower than conventional rates, due to the government guarantee. Credit score flexibility. While not government mandated, lenders usually look for a FICO score around 620 or higher. The emphasis is on overall financial stability, rather than just a single score. VA funding fee. Most VA loans have a one-time upfront fee. It varies based on military category and whether it's your first time using the loan. Certain veterans, e.g., those with VA disability, are exempt. This fee can be financed into the loan. Assumability. VA loans are assumable, meaning a qualified buyer can take over your loan, potentially benefiting from your existing interest rate. Certificate of Eligibility, COE. Required to verify your service and eligibility. This is usually a straightforward process. Property requirements. Homes must meet VA property standards for safety and soundness, similar to FHA. Benefits of VA loans: zero down payment, making home ownership highly accessible. No PMI, reduces monthly. Housing costs significantly. Low interest rates, generally more favorable than other loan types. No prepayment penalty. Flexibility to pay off your loan early. Who are VA loans best for? Exclusively for eligible veterans, active duty military personnel, and certain surviving spouses. It's one of the most powerful and beneficial mortgage options available to those who have served. My team and I are deeply committed to serving the veteran community. I recently assisted a young veteran transitioning out of active duty, unsure about his VA loan eligibility. We helped him quickly obtain his COE, walked him through the funding fee details, and secured a great rate with no money down. He moved into his new home weeks earlier than anticipated, highlighting the program's impact when guided by knowledgeable professionals. USDA Loans, supporting rural and suburban home ownership. USDA loans are guaranteed by the U.S. Department of Agriculture. They help low and moderate income individuals buy homes in eligible rural and suburban areas. Despite the rural name, many properties just outside major cities can qualify. The program aims to improve the economy and quality of life in rural America. Key features of USDA loans. No down payment. Like VA loans, many USDA loans offer 100% financing, meaning no money down. This removes a significant hurdle for eligible buyers. Geographic restrictions. The property must be in a USDA-eligible rural area, which can include surprisingly suburban locations. An online mapping tool helps verify eligibility by address. Income limits. Household income cannot exceed 115% of the median income for the area, ensuring the program serves its target demographic. Mortgage insurance. USDA loans have an upfront guarantee fee, currently 1% often financed, and an annual fee, currently 0.35% of the outstanding balance paid monthly. Despite these fees, zero down payment and competitive rates often make them very attractive. Credit score. Lenders typically look for a FICO score of 640 or higher for streamlined processing. Manual underwriting may be possible for lower scores. Property. Type, primarily for single-family, owner-occupied homes, generally modest in size and value for the area. Benefits of USDA loans. Zero down payment, major advantage for eligible buyers. Low interest rates, generally competitive rates. Lower mortgage. Insurance. Annual fee can be lower than FHA's MIP. Who are USDA loans best for? Low to moderate income individuals and families looking to purchase a home in an eligible rural or less densely populated suburban area. I recently worked with a family who found a beautiful home just outside a major city. They initially thought they'd need a conventional loan with a significant down payment. After checking, we discovered the property was in a USDA-eligible area, and their income qualified. We secured them a USDA loan with no money down, saving them tens of thousands at closing. Jumbo loans, financing high-value properties. Jumbo loans are mortgages that exceed conventional loan limits set by Fannie Mae and Freddie Mac. They are for financing high-value properties, typically those priced well into the seven figures, depending on your county. These loans cater to luxury homes or expensive markets where standard limits aren't enough. Key features of jumbo loans. Higher loan amounts. The defining characteristic. If your loan exceeds conventional conforming limits, a jumbo loan is needed. Stricter. Requirements. Due to higher risk, requirements are more stringent. Credit score. Excellent credit. Often 700 or higher, frequently 740 plus. Down payment. Typically larger, often 10% or 20%. Sometimes more. Debt to income. DTI. Ratio. Closely scrutinized, often preferred lower than for conforming loans, e.g. 36% or less. Reserves. Lenders often require significant cash reserves, e.g. 6 to 12 months of mortgage payments after closing. Appraisal. Requirements. May require 2 appraisals to ensure accurate valuation. Interest rates. Can be competitive with conventional rates, sometimes even lower, depending on the borrower's financial strength. Benefits of jumbo loans. Ability to purchase high-value homes. Opens opportunities for properties beyond conventional limits. Flexible terms. Offers various loan terms similar to conventional loans. Consolidated financing. Allows financing the entire high-value property with a single loan. Who are jumbo loans best for? Affluent borrowers with excellent credit, substantial assets, and the financial capacity for larger mortgage payments. My experience includes working with clients on various types of jumbo loans. I recently helped a client acquire a substantial property in an upscale area. They had a strong financial profile, but wanted to retain maximum liquidity. We structured a jumbo loan that met their specific needs, enabling them to secure the property while optimizing their cash flow. Mortgage options for self-employed individuals. If you're self-employed, your income structure differs from traditional employment, which can present challenges for mortgages. However, it's far from impossible, especially with a professional who understands your situation and has specialized programs. The challenges for self-employed borrowers. Income verification. Lenders typically look at taxable income, which for self-employed individuals can be lower due to legitimate business deductions. Income can also fluctuate. Extensive documentation requires more documentation, like 2 years of personal and business tax returns, P&L statements, and bank statements. Business longevity. Lenders generally prefer at least 2 years of self-employment. History. Specific mortgage options for self-employed individuals. Bank statement loans. Lenders review 12 or 24 months of personal or business bank statements to determine qualifying income based on deposits rather than tax returns. This is ideal if tax write-offs reduce your reported income. Profit and loss. P&L statement loan. Some lenders consider a CPA-prepared P&L statement, especially for those with less than 2 years of tax returns, but strong recent income. Traditional loans with careful underwriting. A skilled loan officer can help navigate income verification for conventional or FHA loans by explaining deductions and demonstrating business stability. How mortgage professionals help self-employed borrowers. A key role is to understand your USDA unique income structure. We look beyond just tax returns, analyzing bank statements, business cash flow, and overall financial health to present the strongest case. We can identify lenders flexible with self-employed income. I recently assisted a successful freelance writer whose tax returns showed lower taxable income than her actual earnings. After a traditional bank denial, we analyzed her bank statements and secured a substantial mortgage using a bank statement loan program. This illustrates the importance of finding a lender or broker who understands the self-employed market. Refinancing your mortgage, a tool for financial optimization. Mortgage. Refinancing involves replacing an existing mortgage with a new one. It's a critical financial strategy for current homeowners. Reasons why homeowners refinance: lower interest rate. If rates have dropped, refinancing can significantly reduce your monthly payment and total interest. Shorten loan term. Refinancing from 30-year to 15-year pays off your home faster, saving substantial interest. Access cash. Cash out refinance. Borrow against home equity to receive a lump sum for improvements. Debt consolidation or other expenses. Remove private mortgage insurance, PMI. For conventional loans, if equity hits 20%, you might refinance to a new loan without PMI. Change loan. Type. Switch from an ARM to a fixed rate or FHA to conventional. To eliminate MIP, consolidate debt. Use cash out refinance to pay off high interest debt. Key factors to consider. When refinancing, current interest rates. Are they significantly lower than your existing rate? Closing costs. Refinancing incurs fees. Ensure savings outweigh these costs. Break-even point. How long it takes for monthly savings to offset closing costs. How long you plan to stay. The longer you stay, the more beneficial refinancing likely is. Your financial goals. What do you hope to achieve? Lower payments, faster payoff, or cash. Mortgage professionals offer expertise across various refinance programs: FHA Streamline and Cash Out, VA Streamline, IRRRL, and Cash Out, USDA Streamline, conventional, and jumbo refinance options. This comprehensive knowledge assists homeowners with their refinancing needs. I recently helped a couple with an FHA loan. With lower rates and a desire for home renovations, we executed an FHA cash-out refinance. They secured a lower rate and funds for their kitchen remodel. Surprised by the ease and long-term savings. Choosing the right loan. Your personalized path. We've covered many loan types. The key takeaway: there is no one-size-fits-all mortgage. The best loan for you depends entirely on your unique financial situation, credit, down payment, income, military service, and long-term goals. This is where working with a knowledgeable mortgage professional becomes invaluable. An independent mortgage broker isn't tied to a single bank. They have access to a vast network of lenders and loan options. Their role is to analyze your circumstances and find the mortgage product that is the absolute best fit for you, acting as your advocate for the most competitive rates and terms. Mortgage professionals take the time to explain every detail, simplifying complex jargon so you understand your mortgage. The goal is for you to feel empowered and confident throughout the entire process. Your next step: let's connect. Understanding these loan types is a powerful first step. The next, and most crucial, step is a personalized assessment. Many mortgage professionals offer initial consultations, often including a soft touch credit check to explore options without impacting your credit score. It's a no-obligation way to get clear answers and a roadmap for your home ownership journey. Don't navigate this complex landscape alone. Whether you're a first-time buyer, a veteran, self-employed, or looking to refinance, a dedicated mortgage professional can guide you every step of the way. We're committed to providing exceptional service and support, ensuring a smooth and efficient process. Ready to find out which mortgage loan is the perfect fit for you? Visit DuaneBuziakMortgageBroker.com or call 804-212-8663 to schedule your consultation. Let's make your home ownership dreams a reality. Thank you for watching, and I look forward to helping you soon.